The global financial landscape is currently witnessing a maneuver that many analysts describe as a bitter meat trick, a strategic self-inflicted wound designed to mask a much larger agenda. While international attention has focused on the volatility of Japanese government bonds, where 40-year yields have surged past 4%, the underlying reality suggests that Japan is not merely experiencing a domestic crisis. Instead, it appears to be using the perceived instability of its own debt to facilitate a massive withdrawal from the United States bond market. For decades, Japanese debt was known in financial circles as the widowmaker because betting against it led to ruinous losses. It was the ultimate symbol of safety. However, the recent lack of buyers for these bonds is being framed by some as a scripted performance. While the official narrative blames rising inflation and the Japanese central bank's decision to stop printing money to support its own debt, a deeper strategy may be at play. As the largest foreign holder of United States debt, Japan has long acted as a diligent worker, borrowing at home for nearly zero interest to invest in American treasuries for a profit. The shift toward raising interest rates in Japan has fundamentally changed this dynamic. Large Japanese institutions, including major banks and insurance companies, are finding that the returns on American debt are no longer attractive when compared to domestic opportunities. Consequently, they have begun a massive sell-off of United States Treasuries to bring their capital back home. By allowing the domestic bond market to appear shaky, Japan provides a smokescreen for this historic divestment from the American economy. The implications of the world's largest creditor leading a stampede away from United States debt are profound. If a global sell-off is triggered, the United States faces two grim options: enduring astronomical borrowing costs that could paralyze its debt-dependent economy, or forcing its central bank to print money at a scale that renders the dollar nearly worthless. Such a collapse would ignite global panic, causing investors to flee risk assets like stocks across all major markets, from New York to Shanghai. In the ensuing chaos, capital will seek absolute certainty. While some funds will rush into physical United States dollars and gold, the ultimate historical haven, smarter money is expected to seek out nations with robust domestic markets and complete industrial systems. This transition marks the beginning of a massive global wealth redistribution that could last a decade. As the dust settles, the financial world may find that the traditional pillars of safety have crumbled, giving way to a new era where economic self-sufficiency and industrial strength are the only true currencies of value.